Okay, so a question I get a lot of times when it comes to real estate is capital gains. Like, what are the impacts of capital gains? Which I think this question is funny because capital gains for long term is less than what your income taxes are. So it's like, yeah, you just made $200,000 when you sold this house. You're going to pay taxes, but it's still a lot less than income tax. Yeah. But what does that look like? So I know you have to live in it for at least 2 years as a primary to avoid capital gains when you sell. But what if I live in it for 2 years and then I rent it out?
Sure, that's a good question. So the Section 121 exclusion that you're talking about is if you occupy a house as your primary residence for 2 out of the last 5 years, you can exclude up to $250,000 of gain on a single filing return, $500,000 on a married filing joint return. If the gain exceeds that portion of the gain is taxable, but that's the built-in gain exclusion. You can occupy it as your primary residence for 2 years, rent it out for 3 years, but as soon as that passes the 5-year mark, you've actually gotten rid of your exemption or your exclusion of the original gain. So you have to be very diligent about keeping it within the 5-year period. The IRS, it wasn't drafted for this to be the rule. So the way that they drafted it was so that interim period of you leaving the house and actually selling it isn't counted against you. However, that's what opens it up to have that 3-year potential rental period because it is drafted that you don't have to live there anymore. It's just from when you move out until you sell it. That's how you're able to use that 3-year period as a rental.
Okay.
If you sell it after that time, you can exclude the capital gain. However, you might have depreciation recapture on the rental period, so it's not a completely tax-free event when you sell it. There are potential implications from the rental piece of it. But another really important point for that is you cannot flip that time frame. You cannot buy a house as a rental property, rent it out for 3 years, occupy it as your primary residence for 2 years, and still get that full gain exclusion. Because like I said, it's kind of a loophole that people are able to use to.
So just to make an example, so I purchased a home, I lived in it for 2 years, I bought it in 2014, and then since then it's been a rental. So if I were to sell it today, what would my capital gains look like?
You would have full capital gains. There would be no exception for it being a primary residence because 2014, the look back period is only 5 years.
Because it's after the 5-year point, so now I'm subject to those capital gains as well as depreciation that I took because for rentals, we write off depreciation, so I'm subject to both. But what is the percent for long-term capital gains generally?
It depends. So long-term capital gains rates are based on your ordinary income tax rates. And so it really kind of depends on the individual tax situation and what the actual gain is and what the other sources of income are. So definitely something to talk to the CPA about and something that can be done and planned for proactively prior to the sale so that way you know what you're looking at in terms of capital gain because the ultimate tax owed is going to be on your total tax picture.
So that's where you want to, again, we keep using the word, have strategies and strategize when it comes to business. And now you want to do the same thing when it comes to real estate because there are ways to lower that tax implication. So that's really important that you plan that out. Okay, so tell me a little bit about short-term capital gains versus long-term capital gains when you are selling. Let's just focus on real estate. Stocks and things will come into play. But if you purchase a house and you sell it within the first year, that would be short term. And if it's after 2 years, it's long term?
It's after 1 year.
After 1 year, it's long term. Okay. Mm-hmm. So what does the short term capital gains look like?
Short term capital gains are going to be based on your ordinary income tax rate versus long term capital gains are based on that rate, but are their own separate rate. So there are different tiers of the long-term capital gains rates, which depend on your other sources of income on the return, whereas short-term capital gains is the equivalent of your ordinary income tax rate.